4%. That's the number. Japan's 40-year government bond yield just crossed 4% for the first time since that maturity was introduced in 2007. But here's why that number matters more than the headline suggests. It's the first time any Japanese government bond of any maturity has touched 4% in over 30 years. Not since December 1995 has Japanese sovereign debt demanded this kind of return. Hold that date. We'll come back to it. The 10-year yield is now trading above 2.3%. That's the highest since 1999. The 30-year just printed 3.88%. The moves in a single session exceeded 25 basis points on the long end. That kind of single-day repricing in the third largest bond market on the planet does not happen during normal market function. It happens during regime change. This is not volatility. This is the sound of an assumption breaking. For 3 decades, the Japanese government bond market operated under a single, unspoken contract. Yields would stay low because the Bank of Japan would make them stay low. Investors didn't need to price fiscal risk because the central bank absorbed fiscal risk. They didn't need to price inflation because Japan didn't have inflation. They didn't need to price duration because duration was subsidized. That contract is now void, and the implications extend far beyond Tokyo. Because Japanese institutions don't just own Japanese bonds, they own trillions in foreign assets. American Treasuries, European sovereigns, corporate credit globally. The largest pool of patient capital in the world is now staring at domestic yields that are suddenly competitive, just as their existing holdings are printing losses they haven't seen in a generation. What I'm going to walk you through is not what the market is saying. It's what the market is doing. The plumbing underneath the headline, the mechanics of how Japan got here, what broke, why the official explanation doesn't hold, and what the math now requires. This isn't speculation, this is arithmetic. Let me start with the quiet signal that almost no one caught. In the 3 months through March 2025, Japanese life insurers reduced their holdings of government bonds by 1.35 trillion yen. That's the third largest reduction on record and the steepest since 2017. These are the institutions that have been the backbone of demand for long-dated Japanese debt for decades. Their entire business model is built on matching long-duration liabilities with long-duration assets. When they stop buying, it's not a preference shift, it's a structural constraint binding. Stay with me here. By June 2025, the combined unrealized losses on domestic bonds among Japan's 4 largest life insurers exceeded 9.83 trillion yen. Nippon Life alone reported unrealized losses of 3.6 trillion yen on its government bond holdings, more than triple the prior year. Dai-ichi. Life's paper losses on domestic bonds stood at roughly 2 trillion yen. Now these are unrealized losses on paper. The bonds haven't been sold, the losses haven't crystallized. But here's where the mechanics matter. These institutions operate under solvency regimes. Starting in March 2026, new economic value-based solvency regulations take effect. These rules require insurers to account for mark-to-market impacts on their capital ratios. When bond prices fall, capital ratios fall. When capital ratios fall below thresholds, insurers face regulatory intervention. So you have an entire sector that bought long-dated bonds at near zero yields, now sitting on assets that are worth significantly less, while facing new rules that will expose that loss on their regulatory filings. The response has been predictable. Some insurers are reclassifying holdings as held to maturity to avoid recognizing losses. Sumitomo Life, formerly committed to holding affected bonds until maturity, which under Japanese accounting rules allows them to bypass immediate write-downs. But that flexibility comes with a cost. Those bonds can't be sold unless prices recover. This is where it turns. Because the traditional buyers of long-dated Japanese government bonds are either stepping back, locked in, or actively reducing exposure. Life insurers trimmed holdings. Banks face regulatory limits on interest rate risk in the banking book. The Bank of Japan is reducing its purchases, and the government is still issuing. The question that should be asked is not why yields are rising. The question is who is left to buy at these yields. Let me explain what the official narrative will be and why it doesn't hold mechanically. The story you'll hear is that this is a healthy normalization. Japan is exiting decades of extraordinary monetary policy. Inflation has returned. The economy is growing. Yields are simply reflecting fundamentals. The Bank of Japan has successfully guided the transition. That framing contains true statements, but it misses the architecture. Japan abandoned its yield curve control program in March 2024. Under that framework, the Bank of Japan explicitly capped 10-year yields at around 1% and intervened whenever the market tested that ceiling. For 7 years, from 2016 to 2024, the central bank was the marginal buyer of last resort. It accumulated over half of all outstanding government bonds. The stock effect of those holdings suppressed yields across the curve. Now the Bank of Japan is reversing course. It began quantitative tightening in mid-2024, reducing monthly bond purchases by 400 billion yen per quarter. By March 2026, monthly purchases will be halved to 3 trillion yen. The balance sheet has already shrunk by over 60 trillion yen, but here's the math that doesn't work. The Bank of Japan still holds approximately 50% of all government bonds outstanding. It's reducing that share at a controlled pace, but the government is still running deficits. The fiscal year 2026 budget approved in December calls for record spending of 122.3 trillion yen. New bond issuance to cover the shortfall will exceed 29 trillion yen. Debt servicing costs alone will hit 31.3 trillion yen, the first time ever above 30 trillion. So the central bank is buying less, the government is issuing more, the traditional institutional buyers are constrained, and foreign investors, who now account for roughly 65% of monthly cash JGB transactions, are being asked to absorb the difference. That's not normalization. That's a supply-demand imbalance with no natural clearing mechanism. Let me walk you through how this system normally works, and then I'll show you where each layer adds fragility. Start with the government. Japan's gross public debt stands at approximately 1,324 trillion yen, or 235% of GDP. That's the highest debt burden among advanced economies by a wide margin. But for decades, that ratio didn't matter because the cost of servicing that debt was effectively zero. When you can borrow at 0%, the size of the debt is almost irrelevant to annual budgets. That assumption no longer clears. The interest rate used to calculate debt servicing costs in the fiscal year, starting April 2026, has been raised to 3%. That's the highest since 1997. Every 1% rise in average borrowing costs adds trillions in annual interest payments. The government's own projections show debt servicing costs rising to 35.3 trillion yen by 2028, a 25% increase in 3 years. Now add the second layer, the central bank. The Bank of Japan bought bonds at near zero yields during quantitative easing. Those bonds are now underwater. As yields rise, the market value of the Bank of Japan's holdings falls. The central bank is also paying interest on excess reserves held by commercial banks. When policy rates rise, those payments rise. The gap between what the Bank of Japan earns on its assets and what it pays on its liabilities is turning negative. This creates fiscal costs for the consolidated government. The Bank of Japan's losses reduce remittances to the Treasury. In effect, the central bank's exit from extraordinary policy comes with a bill that the government must pay. Third layer, the commercial banks. Japanese banks hold government bonds as core assets. They're subject to interest rate risk regulations that cap how much duration exposure they can carry. As yields rise, bond prices fall, and banks approach their risk limits. The banking system can absorb only about 30% of the Bank of Japan's current holdings before hitting regulatory constraints. Fourth layer, the institutional investors. Life insurers, pension funds, and other long-term investors traditionally anchored demand for super long bonds. But, as I noted, they're pulling back. The combination of unrealized losses, regulatory pressure, and uncertainty over the Bank of Japan's next move has shifted their behavior. They're no longer the reliable bid the market assumed. Fifth layer, foreign investors. Foreign holdings of Japanese government bonds have increased as domestic buyers retreat. These investors are more sensitive to fiscal risk than domestic institutions. They're more likely to sell if yields rise further or if fiscal policy deteriorates. And right now, fiscal policy is deteriorating. Each layer depends on the others. The government depends on low rates to service debt. The central bank depends on market stability to exit policy. Banks depend on bond prices to meet regulatory requirements. Insurers depend on yield stability to match liabilities. And the whole system depends on someone being willing to buy at prices that make the math work. This is where the math fails. The single assumption that held this together for 30 years was that the Bank of Japan would always be there. If yields rose too fast, the central bank would step in with unlimited bond purchases. If a crisis emerged, the central bank would expand its balance sheet. If foreign investors fled, domestic institutions would be backstopped by policy intervention. That assumption was never formally stated, but it was universally priced. Every participant in the market built their models around it. Every risk manager treated Japanese government bonds as effectively risk-free. Every liability-driven investor matched their obligations against an asset class whose price was guaranteed by policy. The yield curve control framework made this explicit from 2016 to 2024. The Bank of Japan committed to keeping 10-year yields at 0%, then adjusted the target, then abandoned it altogether. But the implicit guarantee remained in the background, until it didn't. In January 2025, the Bank of Japan raised its policy rate to 0.75%, the highest in 30 years. Governor Ueda signaled that further hikes remain possible if inflation persists. The central bank is explicitly tightening policy while the government is explicitly loosening fiscal policy. Those two trajectories cannot coexist without stress. If the Bank of Japan prioritizes inflation control, it allows yields to rise, which increases debt servicing costs, which worsens the fiscal position, which prompts more issuance, which puts more upward pressure on yields. If the Bank of Japan prioritizes fiscal stability, it suppresses yields through intervention, which allows inflation to persist, which erodes real wages, which weakens the yen, which imports more inflation. There's no policy setting that solves both problems simultaneously. The constraint that bound for 30 years has been replaced by a constraint that binds in the opposite direction. Let me walk you through a stress scenario, not as prediction, but as arithmetic. Baseline: Japan's 10-year yield is at 2.3%. The 30-year is at 3.9%. Debt servicing costs are rising but manageable. The yen is under pressure but not in crisis. Institutional investors are cautious but not panicking. New condition: Prime Minister Takaichi announces a snap election for February 8th. She proposes suspending the 8% consumption tax on food for 2 years. Opposition parties counter with proposals to permanently eliminate the tax. Markets begin pricing expanded fiscal deficits, regardless of who wins. The government's revenue falls by approximately 5 trillion yen per year. That's the annual education budget. To compensate, bond issuance increases. But yields have already risen, so the government must issue at higher rates. Higher rates increase future debt servicing costs. Those costs require more issuance, and the feedback loop begins. Nonlinear outcome: yields don't rise linearly with issuance. They rise with perceived risk. As foreign investors observe fiscal expansion combined with monetary tightening, they begin to question the sustainability of the trajectory. They don't need to sell, they just need to stop buying. And in a market where domestic institutions are constrained and the central bank is tightening, even a pause in foreign demand changes, clearing prices dramatically. This is the scenario that played out in the UK in September 2022 when the Truss government announced unfunded tax cuts. Gilt yields spiked over 100 basis points in days. Pension funds faced margin calls. The Bank of England was forced to intervene with emergency bond purchases just 3 days after announcing quantitative tightening. Japan is not the UK. The Bank of Japan has more tools, more experience, and more capacity to intervene. But the mechanism is the same. When fiscal policy and monetary policy diverge, the bond market becomes the referee. Here's the critical point. In August 2024, a 15 basis point rate hike by the Bank of Japan triggered the largest single-day crash in Japanese equities since 1987. The Nikkei fell 12.4%. The unwinding of yen carry trades cascaded through global markets. The S&P 500 fell 3% in sympathy. That was from a rate hike of 15 basis points, from 0.1% to 0.25%. Since then, the Bank of Japan has raised rates to 0.75%. The 10-year yield has risen from 1% to 2.3%. The 30-year has risen from roughly 2.2% to nearly 4%. The moves that have already occurred dwarf what triggered the August crash, and the market absorbed them. That suggests either positioning has adjusted, or the stress is accumulating in places that haven't surfaced yet. The unrealized losses at life insurers haven't crystallized. The carry trades that were partially unwound have been rebuilt. The foreign holdings that increased have not been tested by a sustained sell-off. This is not stability, this is latent energy. Think of it like a dam. Water pressure builds slowly, invisibly, the structure holds. Engineers monitor gauges, everything looks fine. And then one day, a small crack appears. The crack doesn't cause the failure. The accumulated pressure does. The crack just reveals it. The crack in Japan's bond market is the 4% yield. It's the first time that threshold has been crossed. It's the point at which the system is forced to acknowledge that the old assumptions no longer hold. And once that acknowledgement occurs, the pressure that has been building for years begins to find new outlets. Let me describe the divergence you need to understand. On paper, Japanese government bonds remain among the safest assets in the world. The government borrows in its own currency. The central bank can create unlimited yen. Domestic institutions hold the vast majority of debt. Default is technically impossible. That's the narrative. In reality, the value of holding that paper has changed. A 30-year bond purchased in 2020 at a yield of 0.5% is now worth significantly less than par. The holder can't sell without realizing a loss. They can't hold without opportunity cost. They can't hedge without paying for derivatives that reflect the new rate environment. The paper says one thing, the market says another. This divergence is playing out across every institution in Japan. Banks report capital ratios that treat bonds at book value, while market prices tell a different story. Insurers report solvency metrics that classify holdings as available for sale or held to maturity, depending on which treatment looks better. Pension funds report funding status based on discount rates that may or may not reflect actual clearing yields. The entire system is managing to the rules, not to the reality. And here's why convergence is unavoidable. At some point, someone needs to transact. An insurer faces a claim, a pension pays a benefit, a bank meets a withdrawal, and when they transact, they discover the price, not the price on the book, the price in the market. That's the moment the latent stress becomes realized stress. It doesn't require a crisis. It doesn't require a default. It just requires enough transactions at market prices to force a restatement of what these assets are actually worth. And once that restatement begins, the feedback loops accelerate. Let me give you 3 outcomes, and I'll tell you which one the market is pricing. Outcome 1, everything holds. The Bank of Japan successfully navigates the transition. Yields stabilize at current levels or decline modestly. Inflation falls back toward target. Fiscal policy tightens after the election. Foreign investors remain engaged. Institutional buyers return as volatility subsides. This outcome requires inflation to cooperate, fiscal policy to pivot, and every participant to behave rationally and in concert. The probability is low because the incentives are misaligned. Outcome 2, disorderly repricing. Yields continue to rise as the supply-demand imbalance worsens. The Bank of Japan is forced to choose between inflation control and financial stability. A sharp move in either direction triggers forced selling by institutions facing margin calls or regulatory breaches. The yen moves violently, exacerbating the stress. Global markets transmit the shock through interconnected positions. This is the tail risk scenario. It's not the base case, but it's no longer a theoretical exercise. The August 2024 episode demonstrated how quickly Japanese market stress can propagate. Outcome 3, managed repricing with intervention. Yields rise further, forcing the Bank of Japan to slow or pause quantitative tightening. The Ministry of Finance reduces issuance of super long bonds, shifting supply to shorter maturities. The government moderates fiscal expansion after the election. Institutional buyers gradually re-engage as yields reach levels that compensate for duration risk. This is the most likely path. It requires coordination between monetary and fiscal authorities. It requires market participants to accept losses and move forward. It requires time. But here's the catch. This outcome still involves significant pain. Insurers still face years of underwater holdings. Banks still face constrained capacity. The government still faces rising debt costs. And the central bank still faces a balance sheet that generates losses as rates rise. There is no outcome in which Japan returns to the pre-2024 equilibrium. That equilibrium is gone. The question is how messy the transition to the new equilibrium becomes. Let me shift from mechanics to implications. If you're watching this, you're not looking for advice. You're looking for clarity on what to watch and how to interpret what you see. First, understand that Japan is not isolated. Japanese institutions hold approximately $1.1 trillion in US Treasuries. They're among the largest foreign holders of American sovereign debt. If domestic yields become attractive enough on a currency-hedged basis, they face incentives to repatriate. Even marginal shifts in allocation by institutions of this scale affect clearing prices globally. Second, understand that the yen is a release valve. When stress builds, it often shows up in currency first. The yen fell to nearly 160 per dollar before verbal intervention. If yields continue rising while the Bank of Japan remains constrained, the yen absorbs the pressure. But a weaker yen imports inflation, which tightens the central bank's hand, which means higher rates, which means more pressure. Third, understand that political risk is now market risk. Prime Minister Takaichi's fiscal stance is not just a policy preference, it's a pricing factor. Her proposal to suspend the food tax will cost 5 trillion yen per year. Her defense buildup will add more. Her coalition's slim majority means policy could shift in either direction after the election. The market is not waiting for outcomes, it's pricing probabilities. And right now, the probability of fiscal expansion is high regardless of who wins. Here's what to watch. Watch the 20-year auction results. The Ministry of Finance auctions 20-year bonds regularly. Weak demand at auction, measured by the bid-to-cover ratio and the tail, signals that primary dealers are struggling to place supply. The last several auctions have shown strain. Watch the Bank of Japan's daily operations. The central bank still conducts regular bond buying operations. If it increases purchase amounts or shifts the tenor composition, that signals concern about market function. If it announces emergency measures, that signals stress. Watch the yen at 160. That's the level that triggered verbal intervention. A breach of 160 with momentum would likely prompt actual intervention, which burns foreign exchange reserves and creates its own set of consequences. Watch life insurer announcements. These companies report quarterly. Their statements about investment strategy, duration positioning, and unrealized loss management provide real-time intelligence on institutional behavior. Watch credit spreads in Japanese corporate bonds. If sovereign stress begins to bleed into corporate funding costs, that's a sign of broader credit tightening that will affect economic activity. None of these require prediction. They require observation. The signals are visible if you know where to look. Let me zoom out. What's happening in Japan is not an isolated event. It's a case study in what happens when the assumptions that underwrote 3 decades of financial markets begin to fail. The assumption that central banks can always suppress yields. The assumption that inflation is permanently conquered. The assumption that debt ratios don't matter as long as you borrow in your own currency. The assumption that institutional investors will always buy duration at any price. Each of these assumptions is being tested simultaneously in Japan. And Japan is not unique, it's just first. The United States has its own version of this story. Debt to GDP is rising, deficits are structural. The Federal Reserve holds trillions in bonds purchased at low yields. Treasury auctions are showing signs of indigestion at the long end. Europe has its own version. France's fiscal trajectory is questioned. Italy's debt burden is mounting. The ECB is trying to normalize while governments expand. Japan is the leading indicator because it went furthest down the path of unconventional policy. It held rates at zero longest. It accumulated the most debt. It leaned most heavily on the implicit guarantee of central bank support. And now it's showing what the exit looks like. The question is not whether Japan will face a reckoning. The reckoning is already underway. Yields have repriced. Institutions are adapting. The government is adjusting. The question is how long the managed decline can continue before it becomes something else. 4% is not a ceiling, it's a threshold. The first threshold crossed in 30 years. The market proved it can go there, which means it can go further. The institutions that built their business models around near zero rates for perpetuity are now staring at a world where rates might stay elevated for years. The insurers, the pensions, the banks, the government itself. They all wrote obligations, assuming one world. They now have to deliver in another. This is where the patience of markets meets the mathematics of debt. And mathematics doesn't negotiate. Japan has the tools to manage this. It has a sophisticated central bank, deep domestic markets, and a coordinated policy apparatus. But tools don't change arithmetic. They only change timing. The question is not if, it's how long. Watch the yields, watch the auctions, watch the yen, watch the institutions. The story that will be told later is already being written now, in the prices, in the flows, in the quiet decisions being made by risk managers in Tokyo, New York, and London. 4%. Remember that number. It's the first chapter of the next 30 years.